Imagine waking up one morning to discover that the price of your dream car has been slashed not by a few $1,000s, not even by 20 or 30%, but by a jaw-dropping 60%. That's not a sale, that's a declaration of war, and the battlefield is the global auto industry. General Motors has just detonated a bombshell so massive that it threatens to rewrite the rules of car ownership, car manufacturing, and even the future of mobility itself. For years, GM has been locked in fierce competition with rivals like Ford, Toyota, Tesla, and Stellantis, each fighting to control the market with new models, electric vehicle innovations, and ambitious pricing strategies. But this is something entirely different. This isn't just another discount. It's a seismic shift that could collapse profit margins across the industry, drive competitors into desperation, and spark a brutal price war unlike anything we've seen in decades. So why would GM, one of the most powerful car makers in the world, take such a dangerous gamble? On the surface, the move looks insane. Slashing prices by up to 60% threatens their bottom line, enrages shareholders, and risks devaluing their entire brand image. But dig a little deeper and the strategy begins to make sense. GM isn't just selling cars, they're buying time, market share, and control over the future. By detonating this pricing bomb, they've essentially forced every other automaker to either play by their rules or get left in the dust. Think about it. If Ford or Toyota keeps prices high while GM is practically giving cars away, who do you think consumers will flock to? If Tesla refuses to match the cuts, could their EV dominance suddenly collapse under pressure? And if Stellantis tries to hold the line, could their sprawling lineup of brands start bleeding inventory? This is the definition of high-stakes chess. Except the chessboard is the global auto industry, and every move GM makes could send shockwaves through factories, dealerships, and supply chains worldwide. Already, whispers are spreading in Detroit boardrooms and Tokyo high-rises executives scrambling to understand how GM pulled this off, and more importantly, how they can possibly respond without bankrupting themselves. And here's the real kicker: this may not just be about cars. This could be GM's way of cornering the EV transition itself, luring millions of new buyers into their ecosystem at cutthroat prices, locking them in with software subscriptions, charging networks, and service packages that guarantee long-term profits even if the cars themselves are practically sold at cost. But the bigger question is, what does this mean for you, the everyday driver, the family shopper, the young bear who thought a new car was out of reach? Could we be entering a new golden age of affordability where cars once considered luxury items suddenly fall within reach of middle-class wallets? Or is this just a short-term stunt designed to crush competition before prices creep back up higher than ever? Here's where the story takes a darker turn, because for all the excitement and fanfare, GM's gamble is anything but safe. In fact, it could be one of the riskiest plays the auto industry has seen in decades. Sure, slashing prices by up to 60% wins headlines and floods dealerships with customers, but behind the curtain, this kind of aggressive move has the potential to unravel GM's entire foundation. The most obvious risk is profitability. Cars aren't smartphones, margins are thin, supply chains are delicate, and every dollar counts. If GM sells millions of vehicles at these slashed prices, then there's the danger of perception. Customers love a bargain, yes, but when prices collapse so dramatically, something unsettling happens. The brand itself can lose credibility. Imagine paying full price for a Chevy Silverado or Cadillac just months ago, only to see new buyers walk off the lot with the same vehicle for half the cost. That leaves loyal customers feeling cheated and angry, while luxury buyers might begin to see GM's brands as cheapened, eroding years of careful image building. Once trust and prestige are damaged, they're nearly impossible to rebuild. But it doesn't stop there. The auto industry is a web of alliances and dependencies, and GM's slash and burn strategy could poison its own supply chain. Suppliers who build engines, transmissions, electronics, and raw materials rely on GM's orders being profitable. If GM suddenly can't sustain supplier payments at the same levels, those suppliers could collapse or worse, switch allegiances to rival automakers who still maintain higher margins. That would cripple GM's ability to meet the very demand they're trying to create. And let's not forget about the dealers themselves. While headlines talk about GM slashing prices, it's the dealerships that often bear the brunt of reduced margins. If dealers feel squeezed, inventories pile up, or incentives dry out, The very network GM depends on to push cars to buyers could revolt against them. Perhaps the most dangerous risk, though, is how competitors might retaliate. If Ford, Toyota, or even Tesla match these price cuts, the entire industry could enter a death spiral of collapsing profits, what economists call a race to the bottom. In that scenario, no one truly wins. Carmakers lose billions, workers face layoffs, and even buyers eventually pay the price as bankruptcies shrink competition and choke future innovation. GM may believe it can outlast its rivals, but history shows even giants can topple under the weight of their own ambition. Now the question becomes, did GM plan this as a short-term market shock to rattle competitors, or are they really ready to survive the long, brutal war they just ignited? Because if this gamble backfires, it won't just be a failed strategy. It could be the trigger that sends GM, and maybe the entire US auto industry, into one of its darkest chapters yet. If GM has just thrown the first punch in what could become an industry-wide price war, then the next big question is obvious. Who's going to bleed first? And the answer might surprise you, because not every automaker is equally equipped to withstand this kind of shockwave. The most vulnerable are those already sitting on shaky ground, weighed down by thin profit margins, bloated inventories, or an over-reliance on high sticker prices to sustain their business. Take Ford, for example. Their F-Series trucks have been America's best-selling vehicles for decades, but they've also been creeping up in price year after year, banking on brand loyalty and dominance in the pickup market. If GM suddenly slashes Silverado prices by 50 to 60%, Ford has two terrible choices: either hold the line and risk losing millions of buyers overnight, or match GM's cuts and watch their profit margins implode. It's a no-win scenario, and Ford knows it. Then there's Stellantis, the giant behind brands like Ram, Dodge, Jeep, and Chrysler. On paper, they're massive, but peel back the layers and you'll see how exposed they really are. Jeep has leaned hard into premium pricing for SUVs, Ram depends almost entirely on pickups, and Dodge thrives on niche muscle cars. If GM pulls buyers away with dirt-cheap alternatives, Stellantis faces a brutal squeeze, because they can't just drop prices without gutting the very cash cows keeping them alive. And what about Toyota? You might think the world's most reliable automaker is untouchable, but even they could get caught in the crossfire. Toyota has built its empire on steady pricing, long-term trust, and bulletproof quality. But if GM undercuts them by tens of thousands of dollars, the average buyer may not care about Toyota's legendary reputation when the GM option is suddenly affordable on a whole new level. Toyota could be forced to abandon their conservative approach and respond with cuts of their own, which would be unprecedented in their modern history. Tesla, though, might be the most intriguing case. Elon Musk has already proven he's willing to slash EV prices aggressively to stay competitive, but Tesla's business model relies heavily on keeping margins high enough to fund future innovation. If GM starts offering plug-in hybrids and EVs at shockingly low prices, Tesla would be forced to choose between protecting its brand image as a premium EV leader or diving headfirst into a discount war it might not win. For the first time, Tesla could find itself cornered in its own territory. So, how might these competitors strike back? Expect a flurry of moves: Ford leaning harder into financing incentives, Stellantis flooding the market with rebates, Toyota touting reliability and resale value as their shield, and Tesla cutting software and service costs to keep buyers loyal. But here's the catch: every one of those responses carries risk. Too many incentives and profits evaporate. Too much reliance on brand loyalty, and buyers jump ship anyway. Too much panic, and Wall Street punishes them before customers even do. Which means GM's gamble hasn't just disrupted the car market, it's forced every rival into a corner, where their next move could determine not just who wins the price war, but who even survives it. Here's where things get even more explosive, because if GM's gamble spirals out of control, this doesn't just stay an auto industry problem. It could shake Wall Street and even pull governments into the fight. Remember, the auto industry isn't just about cars, it's a backbone of the global economy. Millions of jobs, billions in tax revenue, and entire supply chains are tied to its stability. If a full-blown price war wipes out profitability, we could be staring at a domino effect that rattles everything from stock markets to labor unions to international trade deals. Let's start with Wall Street. Investors are obsessed with margins and growth, not headlines about discount wars. If GM's profits plunge, stockholders won't clap for affordability, they'll panic. Analysts would slash price targets, hedge funds would dump shares, and GM's valuation could collapse overnight. Worse, if Ford, Toyota, and Stellantis are forced to follow suit, the entire sector's stock values could nosedive together. That could set off broader market jitters, especially with pension funds and index trackers so heavily exposed to automakers. Suddenly, what began as cheaper trucks for the people could snowball into a financial crisis where Wall Street pressures automakers to end the war before they bleed out. But Wall Street panic is only half the story. Governments can't just sit this one out either. The US government, for example, has a vested interest in keeping Detroit's Big Three healthy. If slashed prices trigger layoffs at factories across Michigan, Ohio, and Texas, politicians will feel the heat immediately. Washington might intervene with subsidies, tax breaks, or even pressure behind closed doors to stabilize the market. In extreme cases, we could see whispers of antitrust investigations, accusations that GM is using predatory pricing to deliberately destroy rivals, something regulators absolutely hate. Globally, the fallout could get even uglier. Japan's government won't stand by while Toyota gets dragged into a discount death match. It could push back with tariffs or coordinated trade policies. Europe, already reeling from the EV transition, might see this as a destabilizing threat and rally behind VW and Stellantis with protective measures. And China, with BYD and other state-backed automakers hungry for global dominance, they might seize on the chaos to flood Western markets with ultra-cheap EVs, accelerating their takeover while GM and others are distracted. All of this means GM's decision doesn't just risk its own balance sheet, it risks igniting a geopolitical and financial storm. A storm where Wall Street is screaming for stability, governments are scrambling to protect jobs, and international rivals are quietly circling like sharks, waiting for the blood to spread. Now, the question becomes, was GM so blinded by the opportunity to dominate the US market that they underestimated the global and political blowback? Or do they have a master plan that stretches far beyond its short-term sales? For everyday consumers, this price war feels like a dream come true. Imagine walking into a dealership and realizing that the car you once thought was far out of reach, brand new truck, SUV, or even EV is suddenly within your budget. Families that were stretching to afford used cars could now step into new vehicles. Young buyers who never imagined owning anything beyond an aging compact might now find themselves test-driving brand new Chevys, Buicks, or Cadillacs. On the surface, this looks like the dawn of a golden age of affordability, where cars once considered luxuries become mainstream options. But here's the harsh truth. Sustainability is the shadow hanging over every shiny new discount. GM can't simply slash prices by 60% and maintain it forever, at least not without consequences. Car prices are tied to massive costs: raw materials like lithium and steel, labor from unionized factories, shipping, dealership networks, and the research and development that powers the next generation of vehicles. If GM is selling at or near cost, they're relying on volume and long-term monetization, things like software subscriptions, financing packages, and aftermarket service to make up the difference. That means while the sticker price looks amazing, today, the long-term ownership costs could quietly creep up, whether through higher insurance premiums, more expensive repairs, or subscription-based features locked behind monthly fees. Consumers also need to ask, what happens when the war ends? If GM successfully crushed competition, buyers may enjoy rock-bottom prices now, but once rivals weaken or disappear, what's to stop prices from skyrocketing again? A short-term win could lead to long-term monopoly-style pricing, where the lack of real competition leaves customers with fewer choices and higher costs. It's a cycle we've seen in other industries: airlines, telecoms, even streaming services, and the auto industry could be next. Then there's the question of quality. Automakers slashing prices this dramatically might be tempted to cut corners. Will vehicles still hold the same durability, safety, and resale value if margins are razor-thin? Or will we see a wave of cheaper builds designed to survive the showroom floor, but not the test of time? Affordability means nothing if the car you buy today is in the shop tomorrow. And let's not ignore the ripple effect in the used car market. If new cars suddenly flood the roads at bargain prices, the value of used cars could collapse almost overnight. For millions of people who rely on selling their old vehicles to fund new purchases, this could be financially devastating. So yes, consumers may cheer today's discounts, But sustainability is the billion-dollar question. Are we witnessing the start of a permanent shift in car affordability, or is this just a fleeting illusion, a sugar rush of cheap cars that ends in a crash once the dust settles? This price war doesn't just threaten to upend automakers, it could completely rewrite the dealership model that has defined car buying in America for over a century. For decades, the dealership system has thrived on a careful balance. Manufacturers set suggested prices, dealers mark them up, and consumers haggle, often paying far more than the base cost through hidden fees, financing, and add-ons. But if GM keeps hammering prices down by 40, 50, even 60%, that traditional system starts to crack wide open. Dealers, after all, rely on healthy margins to survive. They don't just make money on the cars, they make it on financing, extended warranties, service packages, and trade-ins. If GM's cut/slash those margins to the bone, dealers will be forced to rethink their entire business model. Some may pivot harder into service and repairs, others might consolidate or shut down entirely. And if dealerships collapse in large numbers, GM may find itself in uncharted territory, forced to sell directly to consumers in a Tesla-style model. That alone would be historic, because the dealership system is fiercely protected by state laws and lobbyists who will not go down without a fight. For consumers, this shift could feel like both liberation and disruption. Imagine walking into a buying experience with no haggling, no hidden markups, just transparent pricing at levels that feel shockingly affordable. Online sales platforms could become the new standard, where buyers simply configure a car on GM's site, secure financing digitally, and have it delivered, no middleman required. This would fundamentally change the psychology of car ownership, transforming it from a grueling negotiation into something more like ordering the latest iPhone. But here's the catch. If GM and others lean into direct-to-consumer sales, dealerships won't just vanish quietly. They'll fight in courts and Congress and in state houses across America to protect their turf. This war might ignite a legal and political battle that could decide the fate of dealership franchises nationwide. If GM wins, the very way Americans buy cars could be permanently changed, breaking a model that's lasted over 100 years. And think about what that means for competitors. Tesla has already normalized the idea of bypassing dealerships, and startups like Rivian and Lucid are following the same path. If GM adopts this during the chaos of a price war, Ford, Toyota, and Stellantis will be under immense pressure to modernize their own sales models or risk looking outdated. The result could be nothing less than the death of the traditional dealership as we know it. Now, the real suspense is this. Is GM quietly using these massive price cuts not just to destroy rival automakers, but also to destroy the dealership system itself, clearing the way for a future where they control the buying experience from top to bottom? Because if that's the case, this war isn't just about cheaper cars, it's about reshaping the power structure of the entire American auto industry. This is where the human cost of GM's gamble becomes impossible to ignore. Behind the headlines of cheaper cars and historic discounts are the people whose livelihoods keep the auto industry running: factory workers, engineers, sales staff, mechanics, and dealership employees. And for them, a price war of this scale feel less like a victory and more like a looming disaster. Start with factory workers. If GM is slashing prices so drastically, they'll need to crank up production to meet the surge in demand. At first glance, that sounds like good news: more shifts, more overtime, more hiring. But here's the danger. If margins collapse and GM starts bleeding cash, the very workers building those cars could be the first casualties when cost-cutting begins. That could mean layoffs, wage freezes, or outsourcing critical parts of production. For unionized workers, especially the UAW members who just fought tooth and nail for better contracts, a GM-driven price war could spark fresh tensions. What's the point of winning better wages if the company is forced to slash jobs to survive its own aggressive pricing strategy? Then there are the dealership employees, the frontline salespeople, finance managers, service advisors, and mechanics, who depend on steady margins to keep their jobs. If GM shifts toward Tesla-style direct sales, or if dealer profits evaporate under heavy discounts, thousands of dealership staff could find themselves staring down layoffs or reduced commissions. Imagine a salesperson who's built a career on negotiating deals suddenly seeing their role reduced or eliminated because the manufacturer has taken pricing control into its own hands. Service departments may stay afloat longer since cars always need repairs, but even they could be squeezed if thinner profits force dealerships to cut staff across the board.